Hi, this is John Persinos, Editorial Director of Investing Daily. As a new year gets underway, and it promises to be a volatile year, I want to focus on two interrelated investment themes: passive investing and robo-advisors. Robo-trading has become all the more urgent with the rise of artificial intelligence and the dangers that it poses. Algorithms dominate so much of Wall Street today. Be on your guard. The trend toward putting investments on autopilot could pave the way for another market crash. Individual investors who want to profit from the markets, but don't see themselves as stock-picking wizards, are opting instead for exchange-traded funds, ETFs, and index funds. These vehicles are managed via software algorithms, hence the term passive investing. ETFs that track financial indices have become a major factor for the recent volatility in stocks. These funds act as accelerants, up or down. They could make the next downturn, whenever it comes, worse. During the 2008 global financial meltdown, regulators, they weren't prepared for how derivatives and other quant strategies worsened the crisis. The 2010 flash crash occurred as a result of algorithms and automated programs that manipulated the market. Wall Street seems to have learned nothing. Despite these risks, there's been a proliferation of passive funds that track indices cheaply and others called smart beta investments that mimic elements of what humans do at far less cost. Index funds and ETFs charge annual fees that are only a small fraction of what an actively traded fund charges. The latter need highly paid talent, so to speak, to conduct research and conceive strategy. Since 2000, investors have removed $2.5 trillion from active funds and plowed roughly the same amount into passive ones. About 2/5 of the global industry's equity assets are managed passively, up from nearly zero in 2000. The popularity of passive funds has concentrated financial clout into the hands of BlackRock and Vanguard. They're the two biggest providers of ETFs and index funds. Combined, they hold $10.5 trillion in assets and control 65% of the 1,700 ETFs in existence. This transition on Wall Street from human to machine has been unfolding for many years. Take a look at the following chart. In 2011, 21% of U.S. mutual fund industry assets were passive. That number is projected to increase to 50% by the end of 2025. It's easy to make money with passive funds during a bull market. The true test comes at low tide during a market crash. That's when investors face a strong temptation to sell, which is usually a mistake. It's during times of turmoil that the active approach can make a big difference. As retail investors continue their march toward passive investing, I remain an advocate of active investing. Don't get me wrong, pooled investment vehicles such as mutual funds, ETFs, and closed-end funds still belong in portfolios. I don't want to settle, though, for index performance. At Investing Daily, we strive to beat the market. The wisest stance is a combination of passive with active. In a closely related trend, we're seeing the rise of automated investment services called Robo-Advisors. Introduced a few years ago, these services are being aggressively sold and are quickly grabbing market share. According to data from Statista Market Insights, about $2.76 trillion worldwide was managed by robo-advisors in 2023, a massive increase from as recently as 2017. By 2027, assets under management are expected to reach just past the $4.6 trillion mark. Estimated total revenue of robo-advisors has also seen explosive growth over the past 6 years. While in 2017, the figure was just $7.1 billion, by 2027, the market is expected to generate sales of almost $188.1 billion. Robo-advising, of course, is infused with artificial intelligence. The transition to robo-advisors isn't just a trend, it's a mega trend. However, as 2025 unfolds and Donald Trump moves back into the Oval Office, we're probably headed for a period of political turmoil and market volatility. Because of algorithmic trading, downturns can accelerate like wildfire. My view, if you're not making your own decisions, you're burying your head in the sand. There are proactive measures that not only protect your portfolio, but also retain a growth trajectory. The key takeaway, don't put your portfolio on automatic pilot. Be sure to perform regular performance reviews of your investments and place performance in the wider context of your long-term policies, as well as overall market conditions. And continue turning to the Investing Daily team of experts for advice. Well, that does it for now. If you want to reach a real human being, i.e. me, just send an email to mailbag@investingdaily.com. Thanks so much for watching.